Hi class, welcome to lecture 5.3. This is essentially a review for your test guide for exam 5, and this is going to cover chapters 11 and 12. And I just wanted to start here so that you could see that it's title. I'm not really going to go through these conceptual problems. Let's go down to the math problem. Okay, I'd like to start with problem number 21. A project has expected cash inflows starting with year 1 of $2,500, $3,200, $3,800, and finally in year 4, $5,000. The profitability index is 1.34 and the discount rate is 11%. What is the initial cost of the project? Okay. Now, if you take a look here, you're going to see that I have a definition for the profitability index. So from your lecture, if you remember, that's really just your profit over your cost or your benefit over your initial cost. So what you're going to want to do is find the discounted future cash flows. So what you could do here is use your calculator and put the cash flows for years 1, 2, 3, and 4 into your calculator, and then solve for NPV with I equal to 11%, which is the discount rate. Now, that NPV is not a true net present value. It is more just the present value. You wouldn't want to call it net present value because net present value assumes you've already taken the initial cost out. Okay, but this NPV on your calculator is actually a way of solving for present value. And once you have that, you can put that present value of cash flows into the numerator, put the solve for the initial cost in the denominator and set that equal to the profitability index, which is 1.34. So now you're just going to solve for initial cost, which is some simple algebra, and you'll get $8,150.47. So that's kind of a trick you can do with your calculator to figure out profitability index or one of the variables within that equation. Now in the real world, I doubt you'd ever do that to figure out initial cost, but it does show me that you understand how that equation works if you can solve this problem. Now let's take a look at number 22. You're considering the following two mutually exclusive projects. What does that mean? You have to choose one or the other. The crossover point is 13.28%. That means that their NPV profiles are going to cross at some point, and the project A should be accepted if the discount rate is 12%. Now, how did I know the 13.28% and the A? Well, on the exam, that's what you would be solving for, is those two bits of information. So how do you do this? Well, you can what you're going to want to find are the differential cash flows. So if you look down there, I've kind of written out year 0, 1, 2, 3 again, and I've subtracted each cash flow from each year. Basically, I've said project A's cash flow minus project B's cash flow equals what. So some of you, if you got room, might even just add a third column on your piece of paper. I guess it's technically the fourth column, but third column of project information, and you could call that differential cash flows. And then you write 0, because negative 42,000 minus negative 42,000 is 0. Then in year 1 you'll put negative 16,000 because 14,000 minus 30,000 is negative 16,000. In year 2 you'll put 4,000 because 14,000 minus 10,000 is 4,000. And then in year 3 you'll put 16,000 because 30,000 minus 14,000 is 16,000. So now that you have those cash flows, throw those cash flows into your calculator and your cash flow buttons, and then hit IRR compute. And what you've done now is you have solved for the IRR of the differential cash flows, and that is called the crossover point. You might also hear the crossover rate. Those terms kind of go back and forth, but we'll call it crossover point for right now. And so that is 13.28%, which means that with a discount rate of 13.28%, Project A's NPV and Project B's NPV are going to be equal. Okay, and so you'd be indifferent between the two projects if that was your WACC or your required rate of return or discount rate or whatnot. Now, if it's above it, which project would you like better? And if it's below it, which project would you like? Well, you could pick NPVs that are above this number and below, like try 5% and 20% and then solve for the NPVs, and you'll get the exact answer every time. Okay, but you could also conceptually understand that a higher WACC or a higher discount rate will be worse for the project that gets most of its money way into the future. So if you look at Project A, it gets its big payment in year 3. whereas project B gets its big payment up front in year one. So a high WAC's not going to be as big of a discount, or a high discount rate is not going to be as big of a problem for project B as it was for project A. So project A is, just conceptually is going to be less. It's going to do better when it's less than 13.28%, and project B will do better when it's above 13.28%. Okay, so hopefully that conceptual made sense. If not, like I said, you can just pick an NPV that is above and below that 13.28% and solve for the NPVs, and that'll tell you exactly what answer to choose. But the main point is that the crossover rate is the rate at which those two NPVs for both projects are going to be equal. Let's take a look at number 23. You're making a $150,000 investment and feel that a 12% rate of return is reasonable given the nature of the risk involved. You feel you will receive $58,000 in year one, $64,000 in year two, $76,000 in year three. You expect to pay out $22,000 as an additional investment in the fourth year, so that's a negative. Now, what is the net present value of this investment given your expectations? So, we now have what we call non-normal or unconventional cash flows, meaning that you've got more than one sign change in your cash flows. A normal cash flow stream has a negative initial cost, and then it's all positive cash flows from there on out. In this case, you have a negative one at the end, so you don't want to rely on IRRs, because this is a situation where you might get multiple IRRs, but there's no reason why you can't use the net present value. So just plug these cash flows in, make I equal to 12 and solve for NPV, and bingo, that's it. So don't make this problem harder than it needs to be. And in this case, you get a negative NPV, so would you accept this problem? Absolutely not. Okay, so that NPV has to be positive for you to accept the project. Now let's look at number 24. Rich and Joe are both considering investing in a project with the following cash flows. Rich seems fine with just getting 9%. Joe's going to require 12%. So who, if either of the two, would accept this project? Well, what you're going to do is put these cash flows into your calculator, using the cash flow button on your calculator. So that's cash flow. Make sure you hit second clear to clear these out, because there's only a couple cash flows. So any other cash flows hanging out in years 3, 4, 5 will really mess you up here. Okay, so put those in, solve, use I equal 9%, and down arrow NPV compute. You'll get a negative NPV for Rich. You can go up arrow back to I, change that to 12%, come back down and hit NPV compute, and you'll have an even worse NPV. So remember, if the NPV is not positive, then you're not going to accept this in either case. Now, so what you want to do is look at each one of these as independent situations. So maybe Rich and Joe could both accept the projects if they both made positive NPVs. Okay, so keep that in mind for the exam. I doubt that the exam will pop up with both of them not accepting again. So hopefully that's a big hint for you down the road. So Charles Henry is considering investing $56,000, so that's your initial cost or cash flow zero in a project that's expected to provide him with cash inflows of $13,000 in each of the first 3 years. So you could, when you put those in your cash flows, put them in for 3 years in a row, or just change your frequency to 3. The $16,000 for the following year, so that year 4 is going to be $16,000. That might end up being your second cash flow if you changed your frequencies to 3, though. Okay, but below I'm just doing this one at a time. I'm not changing my frequencies. I'm leaving them at 1. Okay, so at a discount rate of 0%, meaning there's no time value money going on, right? That's an important concept to understand. This investment has a net present value of what? Well, if you're not doing anything with the interest, you can obviously plug these in and make I equal to 0 and solve for NPV, and you'll get negative 1,000. Okay, so I'm just doing this to preview some kind of conceptual issue, which is that you could have also just summed these up, right? So if you look at the cash flows column here, negative 56,000 plus 13,000 plus 13,000 plus 13,000 plus 16,000, what do you think you get? You'll get negative $1,000, right? So if there's no time value money, you can just add cash flows up, right? Now what would you get at 15%? So if you're, at 15%, you're going to go ahead and change that I equal to 15%, and then go back down to your NPV and hit compute. And now time value money is being considered, and this project looks way worse than it did before, right? So now you're over $17,000 in the hole. So remember, you only accept a project if its NPV is positive. Now NPV and IRR are both about the exact same amount of effort to get. Your IRR button's right beside your NPV button on your calculator. Take a look at problem number 26 here. Flour baker's consenting a project with the following cash flows, and you want to know whether or not you should accept this project based on the IRR, and the required return is going to be 7%. So what you want to know is whether or not that IRR is going to be greater than your required return, because your IRR is what you're going to get and your required return is what you need. Put those in your cash flow, hit IRR compute, you get 7.78%. Because that 7.78% is greater than 7%, then you're more than covered over the top of your required return, so you would accept this project. Once again, you could have just looked at NPV to do this project here, but when you're looking at IRRs, be careful. This is a normal cash flow problem with conventional cash flows, meaning that it had that initial cost, which was negative, and then a bunch of positive cash flows thereafter. You wouldn't want to do this project with IRRs if you had unconventional cash flows. You'd either want to modify those using a modified internal rate of return, which we'll talk about later in this test guide, or you just want to use your net present value. Okay, so here we have another profitability index problem and NPV problem. Okay, and just to spill the beans right off the bat, NPV is better than profitability index. But let's take a look. Jefferson International is trying to choose between the following two mutually exclusive design projects, meaning you have to choose A or B. You've got a required return of 9%, and here they're going to tell you the profitability decision rule and the NPV decision rule. And so what you're wanting to do is see which one you would accept with PI, which one you'd accept with NPV, and then which one you would accept even if they disagreed, right? So to do this, take Project A, for example. What you'll do is put all the cash flows in your calculator except for the year zero initial cost. Leave that cash flow zero at zero, not at negative 85,000. Repeat, don't put in negative 85,000 right off the bat. Okay, just the three positive cash flows. Now, go to your NPV button, put in 9% for I, hit NPV, and hit compute. If you do that, you now have the present value. I know it's your net present value button, but it's just the present value without the net, right? You now have the present value of those three future cash flows. You'll put your initial cost, that negative $85,000, you would put that in the denominator, but you don't have to make it negative. Okay? And you'll get a profitability index of 1.3, right? Because you've got your profit over your cost or your benefit over your cost, and that's 1.3. Now, if you go back to your cash flows and you change cash flow 0 to negative $85,000, then go to your NPV button, put in 9, and hit your NPV and compute. Now you've got your NPV. Okay, so that's your $25,660.63. So you'll do that with both columns A and columns B. What you'll get is your profitability index is going to be higher for A, so you would go with A based on that. Your NPV is also higher, so you'd go with A. Now, if they disagree on the test, what you're going to want to do is go with NPV, right? NPV is the trump card, so keep that in mind. I could also see maybe on a test where I might kind of make this more of a conceptual question, or only make you do half of the work and may give you the other half. Okay, but this should be a pretty easy problem on the exam. All right, let's take a look at number 28. This is a whopper because here you're basically doing all of the methods except for AAR, right? So you're going to do payback, you're going to do profitability index, you're going to do NPV, and you're going to do IR. All right, so let's take a look. You got the cash flows, right? And so you got two different columns of cash flows. So whichever project you choose, you're going to use a required return 15%. And if you look at the payback criteria, how do you do a payback criteria? Remember, payback is like going back through the different tax brackets. If you remember those problems, it's where you would see how far you would get through one and then what percentage you got through the other. as a similar kind of idea, I guess, here. So how many years can we get through? We'll take cash flow A. It's cost $79,000. So when do we get our $79,000 back? Well, it's not going to be in year one, and it's not going to be in year two. So if I add those two together, I know that I'm still got a little bit of extra left over. So let me figure out how much I've got left over in that year three. There is what I'm interested in. So if I subtract 18,500 and 33,900 from 79,000, I have 26,600. Now I didn't write that there for just to save space, but that number 26,600, right, is going to go over 41,100, and that's going to give me 0.65, right? That's about 65% of the way into year three I get paid back. So you got 2 full years, then plus this fraction that we just figured out of 0.65, right? So 2.65 years for payback for A. Now for B, to get my 12,500 back, I'm going to go 5,800. That won't do it. 5,300 on top of 5,800. That won't do it. It's going to also be sometime in year three. So let's figure that out. So what I'm going to do here is take the 12,500, subtract off 5,800, and subtract off 5,300, and I'm still left with around 1,400, right? So 1,400 divided by 6,200 is 0.23. So I went 2 full years and then almost a quarter of a way into the third year, so my answer is 2.23 years. So based off of payback, I get payback sooner with B, so I would choose project B. Now, you would find profitability index and NPV just like we did in problem number 27, right? So you're going to throw in all, for profitability index, you're going to throw in all of your cash flows except for cash flow zero. Cash flow zero will equal zero. Like for A, it wouldn't equal negative 79,000. It would equal zero, at least initially, because you're going to just solve for the present value of the cash flow. So if you solve for NPV with cash flow zero equal to zero, you'll get $107,852.07. Now, if you divide that by that initial cost, then you're good, right? So put 79,000 in the denominator. Make sure it's not negative, okay? Because we only put it negative to make the calculator work the right way. All right, so $79,000 would go in the denominator. You solve, you're going to get a profitability index of 1.37. Now, if you'll go back and add in that negative 79,000 for your cash flow zero, and then solve for NPV, you'll get $28,852.07. If you hit IRR compute, you get 28.73%. Right? So you can do the other three also with project B, and you'll want to compare them. The higher profitability index is the one you'd go with. So based off of profitability indexes, you'd go with project A. The higher NPV is the one you would go with. So based on NPV, project A has much higher NPV, so you'd go with it. And then if you look at IRR, project A also has a higher IRR, so you would go with it. So payback says B. Profitability index, NPV, and IRR all say go with project A. Which do you choose? You're going to choose A. Why? Not because three went one way and one went the other, but because NPV told you to go with project A, right? So remember, NPV is the trump card. Now, 29 is your one average accounting return problem. It's super easy. It's two averages. You put the average net income in the numerator and the average book value in the denominator, you're done, okay? So don't let my math here get you confused. It's just that I sometimes have very, very smart students that realize that there's a shortcut in the denominator. If you don't want to do the shortcut, don't. It's only going to save you a couple seconds. Okay, but let's take a look. An investment has an initial cost of $311,000, so that's your cash flow zero, and it will generate the net income amounts shown below. This investment will be depreciated straight line to zero over a 4-year life of project. So that cash flow zero, you're only going to use that in this situation because that's going to be your original book value, and you're going to want to figure out what the average book value is, right? So you depreciate that 4 times to zero. You add those 5 numbers up, 311,000 plus 233,250 plus 155,500 plus 77,750 plus 0, and divide by 5, and you'll get 155,500 for your average book value. Okay. Now, how did I know how to get the other values? Well, it's straight lined. So if you'll take 311,000, right, and then you divide that by 4 for the 4-year life of the project, you'll get 77,750. Okay, so each of those numbers is going to go down by 77,750 all the way down to 0. Now, if you looked in the denominator, though, I also showed you a shortcut where you could just do 311,000 plus 0 divided by 2, or 311,000 divided by 2. Do that and see what happens. If I do 311,000 and divide it by 2, I get 155,500. Now, why? That's not how you normally get an average, but some smart students might realize that because this is straight lined in equal intervals, right, all the way down to 0, that the middle value is also going to end up being your average, right? And if you had like straight line over 3 years, you'd only have 4 values there, so it would be the average of the two middle variables. But the real thing here is don't worry about the shortcut if it doesn't make sense to you, but I just wanted to prove to you that if you thought you could use this shortcut, you can. Okay, but you're just finding regular averages. So just find the average book value in the denominator using straight line depreciation, meaning taking off the exact same amount every year down to 0. You figure out that amount by taking the total book value 0, 311,000 divided by 4, you get 77,750. So you take that off each time, you'll end up with 5 values. Divide by 5, that's 155,500. Okay, so there's your average book value in the denominator. That and in the numerator, it's even easier. You just take the 4 net incomes, add them together, and divide by 4. Okay, so once you get this number, this average accounting return, in this case it's 21.3%, you're going to compare it to some kind of other number, right? It might be a required rate based off of like a WACC or something like that, or it could just be like, some number they made up. And so that's one of the big issues with the average accounting return. In this case, what you're going to get is 21.3%, and that's higher than the 14% that's required. So yes, you would accept this project based on the average accounting return. I don't really like this though, because I feel like you're kind of making up some numbers, and even if, you're using past information. And I also feel like, if this was all there was to it, then maybe some of these numbers could be manipulated as well, based on legal accounting rules. Okay, now problem 30 is a big problem because this is how you deal with an IRR where you might have unconventional cash flows. Now, the only thing you can't really see on the screen right here, but you can see in your test guide, is a comment that says cash flow 0 should be negative. And that's because that's just the way it was supposed to be wrote. So I kind of wrote that in with pen. But anyway, you'll have a negative cash flow 0, and then you got positive cash flows until the end where you have negative. So you've had more than one sign change. That's not conventional, or that's unconventional cash flows, sometimes called non-normal cash flows. And what we want to do is correct this cash flow situation so that you can still use IRR. Now you can just use NPV and that would be fine, but if you want, NPV is only going to give it to you in a dollar amount. And if you want to get a percentage, right, then you're going to have to modify this internal rate of return. How do you do that? We have 3 approaches. I guarantee you that I'm going to break these up into 3 different questions on the test. Okay, so you really want to know how to do this. The discount approach, the goal here is to take that negative $5,100 and discount it back to year 0 so that it can be with that negative 86,000. Then you'd only have one negative cash flow followed by future positive cash flows. Okay, so in this case, the company uses a 7% reinvestment rate and a 12% discount rate. So since we're doing the discount approach, we're going to use the 12%. What you want to do is push that negative 5,100 back 5 years, back to year 0. So N is going to be 5. The I is going to be 12 because that's the discount rate they told us to use. Payment is 0, and the future value is negative 5,100, right? So we push that back to the present value, and you get $2,893.88. Now remember that that's a negative number, okay? But your cash flows, and I mean, just the way your calculator works, it's going to make present value positive. So cash flow 0 is going to be negative 86,000 plus negative $2,893.88. Okay, so that's why now you're going to have a bigger negative cash flow zero, or yeah, a larger negative number is what I'm trying to say. So you'll have negative $88,893.88 for cash flow zero. So put that in. Okay, go ahead and put that in your calculator in cash flows after you've cleared out your cash flows. Go ahead and put that in for cash flow zero. And then put the other 4 positive cash flows in. So there won't be anything for cash flow 5, but you'll put the other 4 in. And now for to figure out this modified internal rate. So once again, if you solve for IRR with those cash flows, you'll get the modified internal rate of return with the discount approach. Now remember, look at step 3 there with the discount approach. Cash flow zero is going to, this new cash flow zero that we got from step 2 is going to replace the old cash flow zero that you see up there of negative 86,000. And then you're going to leave out cash flow 5. Okay, so you put those cash flows in your calculator, and then you should get 4.29% for your IRR, which is now your modified internal rate of return. Okay, moving to the reinvestment rate, or just the reinvestment approach. You're going to use the reinvestment rate that they gave us, which is 7%, and you're going to keep it. One reason to do the discount approach at first is because you can kind of keep your same cash flows if you know how to do this. Keep the same cash flows in the calculator, okay? But you want to make your cash flow zero, in this case, 0. Why? Because with the reinvestment approach, what we're trying to do is forget about that negative cash flow near 0, starting all over again. Look at those, just the cash flows that are up in the table. So forget about that negative 86,000, make it 0 for right now. And we want to push the other 4 positive cash flows, 10,800, where's that, 600? Yeah, sorry, that's 600. So that 10,600 plus that 23,200 plus that 49,100 and that 16,700. You want to push all of those forward to year 5. Okay? And what's going to happen is when you do that, then you're going to end up with a much more positive number for year 5. So you'll only have 1 negative value in year 0 and then 1 positive value in year 5. So go back to these steps here. Once again, keep all the same cash flows except for cash flow 0. Make it 0. Get your NPV at 7% instead of at 12% because we're using the reinvestment rate now. And you're going to solve for NPV. Now in this case you should get $82,990.90. All right. Now if you'll make that your new present value, okay, you can make it negative, okay, and push that net present value forward 5 years so it's your net future value, then what you're going to end up with is $116,339.03. Okay. However, in year 5 you also are going to have that negative $5,100 cash flow. So in step 3 we take that negative $5,100 cash flow out. You'll have a cash flow 5 that's equal to $111,299.03 now. Does that make sense? All right. So all you have now are 2 cash flows. One in year 0 that's negative 86,000 and one in year 5 that is positive $111,299.03. Since you've only got the 2 cash flows, you can just use your time value money buttons on your calculator. You could also put these in the cash flow buttons. There's no problem with that. But let's just put them in our calculator. Make cash flow 5 the future value, make cash flow 0 the present value, payment 0, ends 5, solve for I, and you should get 5.29%. That's going to be your MIRR, okay, for the reinvestment approach. Now, after you've gotten both the discount approach and the reinvestment approach, you can do what's known as the combination approach. So here you're going to end up using both 7% and 12% depending on what you're trying to accomplish. But if you've already done the discount approach and the reinvestment approach, you really don't even have to mess with interest at all, okay? Because you've already done your homework, so to speak. What you're going to want to do in this case is push all the positive cash flows from the reinvestment approach to year 5, but also take that negative $5,100 and discount it all the way back to year 0 like you did in the discount approach. Okay, so in this case, your future value is going to come from step 2 of the reinvestment approach. It's going to be that $116,399.03 you see in step 2. You're not going to subtract the 5,100 out because that gets discounted back to the negative 86,000 when you did the discount approach. So your present value is going to be from step 2 of the discount approach. That negative $88,893.88 is going to be your present value. So make that your present value. Step 2 from the reinvestment approach is your future value. N is going to be 5, payment is 0, and you're going to solve for I, and in this case you get 5.54%, and that is your MIRR, or your modified internal rate of return, for the combination approach. Now, which is better? Well, that may be kind of hard to say, but you can certainly look at these three and take an average if you wanted to. But these are three different ways to find a modified internal rate of return. Now let's jump ahead to practice test, or the test guide part 2 here, where we have chapter 12 questions. If you take a look, I've kind of marked some of this out. I wanted to actually simplify this problem for you guys a little bit, so that's what I did here. In other words, this problem gave you way too much fluff, and I didn't want to distract from the point that I'm trying to teach. Outdoor Sports is considering adding a miniature golf course to its facility. The course would require a $116,000 loan with annual interest of $4,800, and the course would be depreciated on a straight line basis over a 5-year life with a 0 salvage value. Okay? Now, what does that mean? Well, if you take out a loan for $116,000, that's our initial cost. Okay, that's your book value 0. The annual interest of $4,800. Well, if you listen to the lecture, we do not include financing costs, so interest is not going to be included, so you don't have to worry about it. And the course would be depreciated on a straight line basis over 5 years. What does that mean? Well, if you had a salvage value, you could figure an after-tax salvage value, which we'll show later on, based off of straight line depreciation. It's not going to be super important here for after-tax salvage value because they're telling you there is no salvage value, but you still will have to know how to do this to figure out depreciation. So depreciation is going to be that $116,000 divided by 5. All right. Now, the estimated income from the golfing fees would be $92,000 a year. So that's your sales, and then with $34,000 of that being variable costs. Well, you're absolutely going to consider variable costs. And so what's going on in this problem? If you remember from the mini lecture, all we're really trying to focus on are what are the relevant costs that we're going to be considering here, right? Sales and variable costs are obviously things that we would find relevant. A financing cost like interest is not something we would find relevant, okay? So the fixed cost is $13,400, definitely relevant. In addition, the firm anticipates an additional $12,000 in revenue from its existing facilities if the golf course is added. This is called a positive side effect. If you remember from the lecture, that is relevant. That would be added. However, the firm expects its driving range income will decrease by $11,000 each year since the golf course across town closed down. Well, that has nothing to do with this project. That's something totally different. So that's not relevant at all. The project will require $5,000 in net working capital. That's important, and that is definitely relevant, but it's not going to be relevant for solving for the operating cash flow, which is recoverable at the end of the project. So how does net working capital? Net working capital just means like you might need some extra money up front. Maybe you have to buy some golf balls or golf clubs or something like that, and then when the project's done, you'll sell that stuff back off. You're taking out $5,000 in cash flow in year 0, adding it back in the last year. I'll show you that in problem number 32. Okay. If Outdoor Sports has a tax rate of 35%, so there's your tax rate, what is the operational cash flow for this project based on relevant cash flows? Now, we've seen a couple of ways in the past to find operating cash flow. Here we're going to find operating cash flow based on relevant cash flows. So we're going to use sales minus cost, and this basically there's kind of an understood idea here that you're only going to include relevant cash flows there, times 1 minus T, which is 1 minus tax rate, plus DT, which is depreciation times tax, and that's a depreciation tax shield, or at least that's what we usually call it or refer to it as. and that is just telling you that there's going to be some money there because depreciation is really a non-cash item. So you enter in the relevant cash flows where appropriate, you plug and chug, and you end up with a cash flow, operating cash flow of 44,910. All right. Now, question 32 says, what is the net present value of this project? In the previous question of outdoor sports discount rate is 10%. So in an exam, since I randomized my questions, I'll probably add all the information from 31 again into number 32. But what they're asking here is, how do I get the NPV? Well, you have to put your cash flows in your calculator, but you got to make sure you have the right cash flows. So what you're going to do here is take the initial cost, which we know is 116,000, make that negative, and you're going to subtract $5,000 of net working capital that you're going to need up front. So your cash flow 0 is going to be negative 121,000. Then cash flows 1 through cash flow 4 are all going to be just your operating cash flow, 44,910. Okay, cash flow 5 is going to have that operating cash flow as well, but you get that net working capital back, so it's slightly different. It's going to be 49,910. So you put in all those cash flows. With cash flows 1 through cash flow 4 in your calculator, you could make frequency 1 equal to 4, and then cash flow 5 would actually be cash flow 2, right? Or you can just do each one